I would like now to move to our next session, which is focused on ensuring that we ensure a future for agriculture, producing enhanced agricultural crop systems, insurance systems. So a lot of insuring and insuring there. But essentially we're going to hear from Kerry Battersby from the Queensland Farmers Federation, Dr. Shabaz Mushtaq from the University of Southern Queensland, and Dr. Jarrod Kath from the University of Southern Queensland to talk to us about this very important topic. Again, just a reminder to please use that Q&A feature. If you have any questions for our presenters, jot them down as we go. And I'll hand over to Kerry, Shabaz and Jarrod for the next little while. Thank you all.
Thank you, Andrew. This is Shabaz here. I will start first, and then probably I will hand over to Kerry and Jarrod. So within the resilient topic, our project is focusing on agriculture sector resilience. Especially, we are focusing on climate risk management through alternate risk transfer options, mainly focusing on index-based crop insurance. Next slide, please. Before we move on, I'd like to mention that this is a collaborative project between Queensland Farmers Federation, University of Southern Queensland, and Willis Towers Watson, which are the large insurance broker. The way we have split up this presentation, I will go first and will present some concepts of risk transfer management, integrated risk management, and introduce a couple of concepts of index-based resilience. Then I will hand over the forum to Kerry, who is the project manager at Queensland Farmers Federation, and Kerry will discuss stakeholders, especially the farmers' perspectives, especially their willingness to pay, and will identify how farmers sees the index-based insurance. And then I would also then hand over this back to Dr. Jarrod Kath, who would then show some examples of the tools that we have produced, as well as examples of how index-based insurance works in the Queensland landscape, especially focusing on a couple of key industries here in Australia. Next slide, please. Okay, so this is the economic outlook until 2050 when we considered the natural disaster. And as you can see that starting from 2015, the economic cost of natural disasters would increase from $10 billion per year to up to $33 to $35 billion per year. And this is a slide that I picked up from Deloitte Economic Analysis. And I know people in this forum are sitting from different states, so then you could pick up your own state and find out what would be the economic cost of natural disaster in your current states. Well, we all acknowledge that while the other sector have some capacities to manage the economic cost of natural disaster, the ag sector has the lowest capability or ability to manage the natural disaster. This report also highlights, which is a very important point considering we are talking about resilient investments. This report highlights that if we follow the best management practices, or if we follow what are the possible available adaptation options available, we could only recover 50% of this total cost of natural disaster, which is a very worrying sign. So considering our previous speakers were talking about resilient investment, but this report, as well as some of the other studies also mention that if you follow the best adaptation practices that are available, we could only recover 50% of the cost. So the question is, how do we go about it? Please, next slide. Okay, so historically, especially in ag sector, what we have done is we have focused on risk management. We have developed our policies and plans. For example, we have developed plans to improve irrigation systems. We have developed pest management practices. We have relied on a lot of other climate forecasts, soil pros. There are many risk management options available. And in patches, we have adopted a bit of risk transfer options, for example, insurance. But here in Australia, the insurance market is very thin, and it's sad to know that currently there are no multi-peril crop insurance sold here in Australia. So there are very little that is available currently in insurance landscape here in Australia. There are policies available. They may be index-based or single peril, but they are very limited. But here in this project or in this talk, I would argue that a careful integration of risk transfer and risk management strategy may achieve or may help us to maximize our resilience. We'll show how in the next couple of slides. Next slide, please. This is a slide which indicates the total cost of drought in China. So if you can see, the total cost of drought is about 2.5 billion in China. The x-axis shows the total cost, and the y-axis shows in this slide is the cost benefit of different options. So in this project, which is conducted by Swiss Re, they have applied all possible adaptation options to manage from drought risk. And if you can see that the green bars shows different options and their ability to recover from drought. For example, the first one is, in this example, is soil conservation practices. So if you adopt in Australian landscape, for example, the soil conservative practices, these are the most economically viable option, but it will only recover $100 million worth of net present value. So if you keep going down, if you can see, hopefully you can see in the middle somewhere, there's a orange box there. And at that point, this slide shows that you will reach the limit to adaptation. What does it mean is that at one point, the economics of any resilient or any adaptation options won't make sense. And this is very consistent to the finding that we have received from Deloitte Economics. Whatever we do, we cannot recover more than 50 or 60% of the total damages. The second part in this slide is to show once we reach the limits to adaptation, then is the point you start thinking about risk transfer option. The benefit of this is, especially from the insurance industry point of view, that they don't need to manage the whole risk. In this case, the insurance industry would only need to manage what we call it a residual risk. So instead of managing whole 2.5 billion here, the insurance industry needs to manage only about $500 million or more cost of the drought, which mean that insurance option would be rather cheaper and most cost effective. So with this mind, with this framework, I would mainly focus on risk transfer. But as I mentioned that this whole project or program is funded by Queensland government and under drought and climate adaptation plan. So the rest of the DCAP program is looking for different risk management option, but our project is only focusing on risk transfer option. So rest of the talk that we do is mainly focusing on risk transfer option. Next slide, please. So what we're trying to achieve here is, as I mentioned before, we want to have resilient agriculture sector and through improved risk transfer options. And I have highlighted or some of the key characters of how do we achieve this. We want to develop targeted, cost-effective, and affordable index-based crop solutions. And probably this has been discussed already in different talk. And then also we want to increase the awareness and understanding of the processes which risk could be shared between the farmers and the insurance industry. We hope that this project would lead to some new opportunities in future that would transfer some of the risk from the government as well as from the farmers to the insurance sector. So yeah, so we are somewhere in the middle of the project, or slightly 60%, but we have developed some really important findings out of this project. We'll hopefully share with you. Next slide, please. Okay, so I mentioned that we are focusing on index-based insurance solution. So there are two types of index-based insurance solution. On my right side is what we call it parametric insurance solution. An example here is a cyclone risk. The parametric is, in statistical terms, call it 0-1. If a disaster happens, then it would trigger the payout immediately, otherwise no. So for example, we have developed a cyclone insurance products here. So and we have developed a indemnity zone. So as soon as this cyclone would cross through a circle, which could be a 50 kilometers or 100 kilometers of circle within where farmer is located, the insurance payment would be triggered. No question asked. It's very transparent. It helps in reducing moral hazard, and the sort of index-based insurance solution does not rely on very costly loss assessment. As soon as the cyclone would move through this indemnity zone, the insurance payment would trigger. On your left side of the screen, which is mostly a more traditional index-based insurance, and this is based on an index. An example of this one would be, for example, a rainfall. So farmer or any stakeholders could have a insured against, for example, rainfall. So anytime when the rainfall would go below their threshold, a sort of payment would be triggered. And we'll show some example later on when Dr. Jarrod will present. Next slide, please. There have been examples of the index-based insurance solution. Globally, they are based on temperature. They are based on precipitation or rainfall. They are also based on windstorm. There are new indices that are currently available now based on crop yields or agriculture quality. But there are some new thinking around terrorism, pandemic, or we're talking about COVID. So hopefully in future, there would be a COVID insurance index available. But currently there are 3 or 4 indexes that are currently operational. But while we are arguing that index-based insurance is cheaper and more affordable, on the right side of this screen, you can see a box which indicates that there are issues with basis risk. There are issues with data. Basis risk is can be explained that, for example, a farmer is buying his index base around the Bureau's weather station, and his premiums and payout would be triggered against the weather station, which is managed by BOM, but the rainfall profile in his farm is slightly different than the weather station reading. So it could be the case that the weather station where his payment and payout will be triggered won't show any drought or anything below the threshold, but his farm is suffering from drought or a way below rainfall. So that's what we call it basis risk. Basis risk is an issue. The availability of data is an issue, and without going into more detail, so these are the issues, the prerequisite for having this index-based insurance solution. I think I'll stop here, and I'll let Kerry to describe the farmer's perspective on this index-based and cyclone insurance products.
Thank you, Shabaz. Well, let me give you a little bit of background in terms of Queensland Farmers Federation. We represent industries that include sugarcane, cotton, horticulture, production nursery, dairy farmers, chicken producers, egg, pig producers, as well as 8 separate irrigated groups across Queensland, and we're across most of the local government areas. So let's start with Cyclone Debbie in 2017. It was a catastrophic event for impacted industries from agriculture, from the north of the state through to central and then to the southeast of the state. Now, on this slide is an image of damage at a farm. And let me read with you the words written by a sugarcane farmer in North Queensland. Here's his quote, and here's an image of the damage that he sustained. My cane farm was directly in the path of this Cat 4 Cyclone Debbie system. We had winds of up to 265 kilometres per hour, followed by over 1,000 millimetres of rain within a 48-hour period. We had 2 sheds completely written off. 1 shed suffered major damage to our home and 50% loss of infrastructure. The consequence for this farmer was a loss of production over 3 years, 40% loss of production in the first year, 30% loss in the second year, and 25% loss in the following year. So recovery is long-term and it is costly. Sheds might be insured, but crop and stock insurance is expensive or, for an increasing number of farm businesses, simply not available. Now, I've been to a few AIDA conferences and I know some of you. So if you are working in the community space with community recovery, please remember this point. Most farmers live on site. When their business is hit, so is their home. They lose both home and work, and they most likely draw on their own savings to continue to employ staff and sustain their own family after a disaster. So the lesson for us in community recovery is we must not just drive past their property and assume they have insurance to recover from the loss. Please, please, please check on them. Next slide, Andrew. So QFF recognised a critical need for a different way of looking at insurance. As part of the DCAP program, we work with Shabaz and his team at USQ Toowoomba and the insurance team at Willis Towers Watson as part of the Queensland Government DCAP project. This is collaboration working at its best, always with the end user in mind, the farmer. So, as a team, we identified the priority issues. Farmers working in a highly variable climate, as you'll see in the first dot point, experiencing droughts and floods. And remember, 67% of Queensland is still drought declared at the moment. Insurance, in dot point 2, insurance plays an important role, but as you'll see in dot 3, it's poorly understood and utilised by farmers if it is available at all. Next slide, Andrew. Thanks. So Shabaz has explained the need for an improved risk transfer options and looking at a parametric index insurance model. So here, QFF and the team identified 6 priority benefits for farmers. The first one, parametric solutions are an alternative way of transferring the cost impact of natural disasters such as cyclones. Point 2, farmer experience with insurance, as we know, has been fraught with problems, especially at claim time. So this solution is actually different. The defined event actually triggers a payout. And in point 4, flexible policies can be designed for the specific farm location, risks, and the business objectives of the farm business. And in point 5, it can be single season, multi-year arrangements, or claims can be quickly settled and there's no need for a claims assessor to visit and have that horrible situation after you've gone through a cyclone or a flood where the loss assessor comes in and potentially knocks you down on a policy, because this policy under this index system is determined by the parameters and what you get is guaranteed beforehand. Next slide. So how do we engage with primary producers? Cane growers, which I'll focus on today, is one of the leading QFF member groups, and we used to test the viability of a parametric index approach to insurance. So we engaged with cane grower member groups, we talked with sugarcane farmers with cane growers policy councils. We conducted workshops, wrote articles, and these 3 case studies, which are just indicated on screen here, we conducted, and you can find a copy of these on the QFF website, qff.org.au. But we asked them the question, what if you were insured during Cyclone Debbie? What would it have cost you to get that insurance? Next slide, Andrew. So this slide and the next 2 slides show the type of engagement we enacted with industry to ascertain the level of interest. Remember, insurance can be considered boring. It's not necessarily their primary purpose. And farmers have had really bad experiences in the past. So to obtain their buy-in, their feedback and their involvement, we use industry groups like cane growers, GrowCom, Nursery and Garden Industry, Cotton Australia. And we talk to their key stakeholders, such as their boards and their subcommittees. And we use regular communications. If they've got an industry magazine available, we put articles into their magazines and their e-newsletters, which you've got here. Next slide. So take note of the QFF web address, qff.org.au, because there are a number of articles, research papers on the insurance page of this website that you may be interested in. The success of this project is collaboration between government, university research, and the agriculture industry and insurance industry. We identify the critical need, apply the best research methodology to analyse the problem, and work with insurance industry and farmers to develop a solution. Next slide. So DCAP is a priority program for the Queensland Government, and we take the opportunity to promote the value of this research and this project and improving insurance options for our farmers. So certainly look at websites such as longpaddock.qld.gov.au, and you can subscribe to the Agriculture News e-newsletter. So at this point, I'd like to hand over to Dr. Jarrod Kath to take us through some of the pilot projects and the online tool developed for the program. Next slide, Andrew, and thanks, Jarrod.
Thanks, Kerry. Hello, everyone. So this is just a range of the different crops that we've done some research on to try and understand the key climate risks that affect those crops. So we've looked at things like cotton, horticulture, macadamia, mangoes, sugarcane and wheat. On the side of the slide you see there, you can see how an index insurance product could be structured for somewhere like Bundaberg. So the purple line there shows the rainfall over a certain period of time. That dotted line at the top shows something called the attachment or trigger level, and that's basically the critical threshold level at which some negative impacts might occur on the farmers and that they might want insurance for if that event occurs. So you can see in that example there at the top that 1, 2, 3, 4, maybe 5 times over the last 30 or so years, there's been periods where there's been very low rainfall. And if the farmer had insurance during those events, they would have received a payout that could have helped them cope with those drought conditions. Next slide, please. So this is one of the pilot projects we have going with cane growers. So cyclone is a really big problem for sugarcane growers, as Kerry outlined. A farmer can lose not only their assets and their equipment and so forth, their production is also impacted quite severely. So we're in the process of developing a insurance program that looks at paying cane growers around $50,000 whenever a Category 3 cyclone hits within 50 kilometres of that particular grower's farm. That's a project that's we're deep into and that's underway and has received lots of good feedback from cane growers. So if you hit the next slide, please. This is an example of an online tool that we've developed to help us engage with the cane growers and sugarcane farmers throughout northern Queensland. It allows farmers to interact with cyclone data over the past 30 or 40 years. They can type in the name of a cyclone, they can scroll to their particular farm or location, and they can see whether or not their farm would have been in the payout zone, which is indicated by that red area there. They can see how much insurance at a particular level would have costed. So they can type in, okay, if I had lost this much during that cyclone event and I wanted that to be recovered, then the cost of insurance would have varied between, you know, this amount or that amount. So it's a tool that allows us to start engaging with farmers and cane grower organisation with some particular detail, so we can start assessing, you know, are these options affordable for farmers? How can we make them cheaper and easier to interact with? And how do we start progressing this towards some real solutions for farmers so that they can have insurance options that can help them be more resilient to natural disasters like cyclones into the future. Next slide, please. So this is another shot of the tool showing a bit more detail, the different options and capability for interaction. You can see you can select the cyclone, you can select the time range, and there's a whole range of different tools there. And we're working on getting this online, and there should be a link to this through the QFF website also. And next slide, please. And this is just another example of something that's a work in progress, a similar sort of interactive tool, but this time for drought. So this enables a farmer to click on their property anywhere in Australia or in Queensland we're focused on, and they can select the seasons or the months that they're interested in. So they might be interested in getting cover over the summer months or the winter months when their crops are particularly vulnerable. They can select how much insurance they want. And again, we give them outputs on how much the insurance would have costed, when those payouts would have occurred, and the size of those payouts. So they can start taking this information, start integrating it into their business management and risk management practices, and ultimately we'll hope help them to develop more resilient farming practices into the future. So I think I will finish up there. Thank you very much.
Fantastic, and thank you to all three of our panelists. Some really interesting insights there. Insurance, I think it was, the observation was made that it's not terribly glamorous and people tend to be not interested until something happens, and then it becomes a really key plank in resilience and recovery. So I think what we've just heard about is a fantastic example of a really good collaborative project with, as was alluded to by Kerry, the end user being very much the focus. So thank you for your insights and congratulations on that. We'll take one or two questions. We're a little bit tight for time, but there's an opportunity for one or two. So I'll address this to all three of you, and whoever is best placed, if you wouldn't mind answering. The work you're doing on insurance is so important to support resilience and recovery, particularly within the context of climate change. Is work like this being done in other states and territories as well, or just Queensland?
As far as I know, that New South Wales government has done some work, and recently National Farmer Federation has awarded, or at least they're running a big program, and under this they have awarded 7 sub-projects, and they are focusing on both risk transfers and as well as risk management options. So different sub-projects have different mandate. For example, a sub-project is focusing only on insurance. Another sub-project is focusing on mutuals and cooperatives. A sub-project is focusing on price risk management. And there are the other 3 sub-projects are focusing on farm and off-farm risk management practices and associated policies. So there's a big program underway right now, is trying to answer those questions.
Fantastic, good to know. And I think again goes back to one of the earlier sessions this afternoon where they spoke about the importance of that collaboration across borders as well as within organisations and across organisations.
Absolutely.
The second question I would ask, someone has asked us, do we have reliable data for crop damage by floods and similar hazards to help work out the cost of insurance and levels of insurance that might be required?
I can take that one if you want, Shabaz.
Thanks, Jarrod.
We don't have very, what's the word? There is a lot of good data out there, but it's often not freely available at a scale that is the best for linking it to things like flood impacts and droughts and that kind of stuff.
Yep.
One of the benefits of this sort of insurance, bud, is that you don't necessarily need that detailed information. If you think of something like a cyclone, for example, you can assume that it's going to wipe out your crop in a lot of cases or have a big impact. So the pricing of the policy is only dependent on the risk itself. So how often the cyclone occurs or how often the drought occurs. So this index insurance method is a clever way of getting around the lack of crop data in a lot of cases. You do of course, need to do lots of careful research to make sure that the basis risk isn't too high. And so basically you need to make sure that the risk is correlating with yield losses. Otherwise, the farmer will not be paying for insurance that he doesn't need. But in a lot of cases, the farmers know their risk quite well. So I would say that isn't a huge risk.
Okay, thanks, Jarrod. And again, thank you to our panelists for their insights today. Kerry, Shabaz and Jarrod, thank you again. It's been, I think, a really fascinating session and one that we've really enjoyed. So thank you all.